For over a century, the global economy was routed through loud, physical rooms that looked exactly like this. If you wanted to buy or sell, you had to physically communicate that intent. A trader read a glowing number on a board, made a calculation, and threw their hands up to signal a trade. The speed limit of global finance was bounded by human biology, how fast a person could process information, react, and move. Today, the physical trading floor is mostly a television set. The real market lives inside dark, heavily air-conditioned data centers packed with humming server racks. There are no voices, and there are no humans. Instead of minutes or seconds, this new market operates in microseconds. A microsecond is 1/1,000,000th of a single second. To put it in perspective, in the time it takes you to blink your eyes, these servers have lived through hundreds of thousands of individual moments. Inside those tiny slivers of time, algorithms propose, evaluate, and execute millions of transactions. They are entirely autonomous, functioning completely outside the bounds of human observation. The stock market is no longer a place where people debate the underlying value of a company. It has become a strictly physical race of speed, running so fast that human comprehension has simply been left behind. This race is called high-frequency trading, or HFT. And while the financial industry likes to treat it as a highly technical niche strategy, it is the dominant operational force running the modern market. The defining feature of an HFT firm is latency, the time it takes for data to move from point A to point B. If a traditional investor places an order, an HFT algorithm on a faster digital track can see that order in transit, race ahead to the exchange, and execute a trade a fraction of a millisecond before the original order even arrives. By winning that foot race, the algorithm shaves off a tiny fraction of a cent in profit. Because the machine performs that exact same maneuver millions of times a day, those fractions aggregate into billions of dollars, which means the prices of the mutual funds, pension plans, and everyday commodities we rely on are heavily dictated by an automated, invisible network exploiting tiny gaps in time. Take a look at this screen capturing the Dow Jones Industrial Average on the afternoon of May 6, 2010. At 2:42 p.m., the market experienced an anomaly it had never seen before. A single automated fund decided to sell off $4 billion in contracts very quickly. Every other algorithm in the network instantly detected that massive drop in volume. Interpreting this as a market collapse, the machines blindly reacted to each other in a microsecond by microsecond feedback loop, violently pulling the market down. The real-world disconnect was staggering. A massive, tangible company like Procter & Gamble suddenly lost 35% of its entire corporate value. No factories burned down, no product lines failed. The underlying business was completely unchanged. 14 minutes later, the machines corrected themselves, and the prices rebounded. But those 14 minutes proved that the market had morphed from a reliable economic measuring stick into a highly volatile machine, perfectly capable of catastrophic malfunction without human input. Some firms don't wait for the market to move. They force it. One tactic is saturation. An algorithm intentionally floods the exchange's data pipe with millions of dummy orders, creating a literal traffic jam that slows down all competing computers. Then the firm routes its actual trade through a clear parallel bypass lane. Another tactic is spoofing. The algorithm places a massive fake buy order, tricking other machines into driving the price up. It then instantly cancels the fake order and sells its real shares at the artificially inflated peak. Regulators caught one Dutch trader manipulating French stocks this exact way, illegally extracting hundreds of thousands of euros in profit in the precise amount of time it takes light to travel 12 inches. These actions are distinct from standard investment strategies. They are deliberate, structural manipulations of the market's plumbing, designed entirely to exploit the biological limits of human reaction time. You might expect severe legal consequences for this kind of market manipulation, but regulatory bodies, like the French Financial Markets Authority here, operate at the slow, bureaucratic pace of paper and committees. When an algorithm commits a crime, the offense occurs and concludes in a single microsecond. By the time an investigator notices the anomaly, opens a case, and spends 18 months tracking the data, the money has already vanished. Even when they do catch someone, the penalties are completely disconnected from the crime. That Dutch trader who extracted 585,000 euros, the regulatory body issued him a fine of just 10,000 euros. The enforcers are chasing teleporting targets on foot. This severe asymmetry means that the modern financial architecture operates almost entirely without meaningful legal accountability. The most unsettling detail is who is actually paying to build this system. In France, institutions like Société Générale actively used millions of euros in public research tax credits, taxpayer money, to develop their high-frequency extraction algorithms. When government officials try to question these practices in the National Assembly, the financial industry deflects. They blur the definitions, hide behind dense technical jargon, and insist their automated trading only has a marginal impact on the global economy. The data tells a different story. These machines now control a full third of all European stock transactions and more than 2/3 of the American market. The only reason the global economy didn't fully disintegrate during the 2010 flash crash is because human operators at the Chicago Mercantile Exchange physically intervened and forced the entire market to halt. A manual override broke the algorithmic spiral. Finance has shifted away from valuing businesses. It is a form of continuous infrastructure warfare. And right now, our only reliable defense against total systemic collapse is the hope that the next time the machines panic, a human being will be standing close enough to the plug to pull it.